What is going on, everyone, and welcome to Stock Market After Hours. My name is Mark Rusin. It is fantastic to be with you guys on this Wednesday afternoon or evening, depending on where you're at. Maybe if it's even Thursday morning in some places, depending on where you're watching this. But as always, it's great to be with you guys. Let me know, where are you tuning in from? What have you been buying or selling? The same way we start each and every week. This is your first time joining. Again, my name is Mark Rusin. I'm a CPA here in the state of California. This is meant to be an interactive time where we just get together for roughly 30 minutes, go over some top news, what am I seeing in the market, and discuss some questions that you guys might have and bring up some topics about what I'm seeing in the market. So as always, thank you guys for joining me. The last Choi. Let's go, Mark. Good to see you. Happy, wonderful Wednesday from beautiful Lehigh Valley, Pennsylvania. That just sounds pretty right there. All right, John Bircher in the house, tuning in from Tulsa. What are we buying, John? XLP, XLV, XLU. John's been on the ETF hunt here. Little Google, NVIDIA, and some AMD covered calls. Nice. Georgia, tuning in from Jamaica. Awesome. We're dipping SCHD big time. Minneapolis, Minnesota. We'll buy on the dip with the SCHD. Google and HIMS for the last Choi. Manchester, UK. There we go. We're going global. From Cyprus, Shaitan, good to see you as always, my friend. Long, how we doing? Are we surviving this week? Buenos Aires, Argentina. Talk about another beautiful place right there. Got Mass Effect 2 on one monitor, you on the other. There we go. Dual purpose. ARCC. I don't trust the rebound. Do you? Great question, Kenneth. We'll talk about that here. Maria tuning in from Charlotte. Venu from Utah. Can I hold NVIDIA? That's a good question, too. Jeffrey, good to see you, my friend. Nibbled on some Microsoft, FIX, SCHD, and a little Meta. And Peter tuning in from Hotlanta. So thank you guys for tuning in here. It has continued to be kind of a whirlwind market. We see a big dip, then a rebound. Tariffs on, tariffs off. We're going to play hardball when it comes to tariffs. Oh, wait, no, I'm just kidding. Tariffs are likely to come down on China. So it just adds to the uncertainty that we continue to see in the market, and us investors hate it. We hate uncertainty. Management teams hate uncertainty, which is why what I've talked about the past few weeks, what are we going to see in this earnings season that we're going through right now? We're going to see companies either bring down their guidance numbers or just pull the guidance altogether and say, hey, how can we give numbers when we don't even know what the economic trade policy is? Are tariffs 145%, or are they going to come down to 50% or even lower? Do we have tariffs on 10% countries across the board, even those inhabited by just penguins? Or are those just going to go away and we're going to have so-called trade deals, even though we had a lot of these trade deals 4 years ago? So again, it adds to the uncertainty. How could you possibly manage a company and give guidance on what you expect when it's a moving target? We're just continuing to move the goalposts right there. So it's going to add to the volatility here. And the question was posed by someone earlier, I believe in the rebound? And the answer to that, again, this is just my opinion, is I don't believe in the rebound. I believe we still have a potential to retest the lows of the past 52 weeks. And that's why I'm putting on option plays. I'm not selling out of all of my positions and shorting the market by any way, because what I talk about also on this program a lot in a lot of my videos is the fact that we can never time the market. And if we miss just a handful of the biggest moves in a particular year, we could vastly underperform the market there. So again, I'm making some moves, and those that are Edge Plus subscribers know the moves that I'm making. I'm never going to know if the timing is right or not. I sold Micron an hour before we had the biggest move in the NASDAQ there. Now Micron has come back down to earth and been a little bit more volatile, so it doesn't look as bad there. So again, I don't have a magic 8-ball. But in terms of getting the question posed to me, do I believe in the rebound? No, because nothing has relatively changed. It's just more headline talk. Headlines continue to drive what is going on in the markets rather than actual data, rather than actual policy. And until we get that, I'm not going to really feel all that comfortable as an investor. So yes, over the past few weeks, I've been getting a few emails saying, Mark, it seems like you're turning a little bit more pessimistic, a little bit more defensive. And that is correct. I'm not going to, hide behind that by any means, because we are diving deeper into this hole of uncertainty. And if the policy continues as is, which is all we can go off of, we have to go off of what is actual policy. What are the facts right now? And the facts are we have tariffs across the board. We get a 90-day pause on a number of different countries. But the two big powers, the big elephant in the room is going to be the U.S. and China. So Trump comes out today saying, hey, it seems like the highest, the 145 is not going to be reality. Those numbers are likely to come down, which I think that was probably well known by most of us. We're not going to charge 145%. But China, being led by the Communist Party there, they can just sit back and say, it doesn't matter to us all that much. But what they are doing is they're going out to U.S. allies and other countries saying, hey, if you export to them, we're going to retaliate against you. Or how about we start doing business together from that? And that could be by far the worst thing from Trump's perspective right now is, okay, we're going to tack on these big tariffs on China, but now all of a sudden they're doing business with many of our close allies. And we're going to start to, as Ken Griffith put it, diminish our brand here in the US. So it continues to be a bit of a mess, and it shouldn't give you any reason to feel a lot more comfortable just because we saw a little bit of a bounce today. What do we end up on the day? If I go back, S&P 500, would it jump 2% around that? So again, it wasn't overwhelming. We finished towards the lows of the day there, so we gave up a lot of the gains that we had there. So we'll definitely have to see how things progress moving forward. So as always, if you guys have questions, I'll try to get to as many of those as I can. Just post those in the comment section if you guys could. Very well appreciate any likes that you can put on there. Definitely helps with the algorithm. So here's a look at where we're at in terms of market performance. The major indices right now: Dow Jones is down roughly 8% on a year-to-date basis. S&P 500 down roughly 8.5%. NASDAQ, the big loser, down 13.5%. And the Russell 2000 is down 12.5% roughly there. So the Russell was actually the worst performing of those four indices right there, but actually had a pretty solid month over the past, or a pretty solid last 5 days, I should say, to surpass the NASDAQ. We got oil sitting in the low 60s right there, and Bitcoin. If anything there, where are we finding some stability right now? Of all places, something I don't talk a lot about on this channel, it's going to be in the cryptocurrency market, particularly Bitcoin. And when it comes to crypto, I only own a very small portion of my portfolio in Bitcoin. I do not have any other crypto coins, meme coins, or anything like that, just as a disclaimer. So Bitcoin has increased roughly 10,000. It was in the mid 80s. It's really hovered there for the past month or so. So we finally broke above 90 and currently sitting at 93 and change there right now. So to give you guys a up to the minute number, we're at 93,340. So slightly below where it was when I updated this chart here. So in terms of valuation right now, the S&P 500 still trading slightly below 20 times multiple, 19.9, which is still elevated from the 18.1 that we've traded at over the past 10 years. Earnings are still estimated to be around 270. And if you join me for my emergency market update that I had last Thursday, thank you guys first off for joining, or for those that watched the replay, I talked about one of my major concerns. Not talking about tariffs necessarily, but tariffs impacted, is the concern around a re-rating with valuation. So we're starting to see a lot of estimates come down, especially after we get through this earning phase that we have right now. We're going to see a lot of re-ratings, a lot of estimates come down from analysts on, hey, I was expecting this, but now we're expecting this in terms of earnings. Most of those are going to likely come down, which is going to weigh on the overall S&P 500 earnings for 2025. And moving forward. So if you think about it, sure, the S&P 500 has come down in stock price, which has made the valuation lower. And I'm just reiterating what I talked about on that emergency market update last week was, let's say that those earnings estimates come down to, say, 250. That all of a sudden puts our S&P 500 multiple higher. And now we're back in a position, even though the market has come down a great deal, we are back in a position of looking at a very over-elevated S&P 500 from a valuation perspective. So right now, if we said the S&P's at, call it 5375, we'll call it 5375, and instead of the 270, let's say we only get 250. That puts our S&P 500 multiple at 21.5. So we go from 19.9, which is already slightly elevated compared to historical average, to now sitting all of a sudden at 21.5. So we've just updated our earnings estimates. So how do we get that multiple lower again? S&P 500 has to come down. So there is plenty of concern as it relates to valuation, to tariffs. Now, if we get policy comes out, we said, hey, we made a bunch of deals, the tariffs are off, or they're just going to be even, and that's the deal moving forward, then all bets could be off there. But we're going to continue to go with the facts that we're given and not as much based on headlines saying, oh, we think tariffs are going to come down, or we think we're going to retaliate. What is the policy right now? That's all we can go off of. Everything else is just headline news. And we're going to get a seesaw market because we're trading off of headline news and not actual data right now. So that's where we sit in terms of valuation. Interest rates are starting to increase actually here. So we had the 10-year go from 4.29 last week when we had our stock market after hours up to 4.39. We had the 2-year go from 3.79 up to 3.88. So this is going in the wrong direction that the administration is looking for. They want interest rates to come down. So there's still a lot of bond selling that's going on right now. So it's definitely not going in the direction that the administration is hoping for. And again, he continues to put pressure, off pressure on the Federal Reserve to reduce interest rates. But if we think about it, if we reduce interest rates and we're looking at inflation that's already high, and you tack on tariffs, which is going to only further push inflation higher, lowering interest rates is only going to add fuel to more inflation there. So it doesn't make sense from an economic policy. And when you look at the job market's still holding together. So there's no real need for the Fed to cut rates right now. There's just no data that's pointing to, hey, we need to do a rate cut right this instance. So that's kind of my take overall. What do we got here? Let's pray for Alphabet earnings tomorrow. My second biggest positions. If it's bad or market crashes again, I'm going in for more. So if you already know that you're going in for more, then maybe you are hoping for a little bit of a pullback there. This market is a text or a tweet from being up 3% or down 10%. Absolutely. Chris has been adding to SCHD. My average is $23 right now. Owned it before the split. Been a couple years. Great time to pick up some of that. Mixed with SCHD or FDVV. Should give near S&P 500 gains based on market conditions. SCHD is a proven winner regardless of its PE. Well, I don't think we can just say regardless of its PE, because valuation always matters. And we have seen that more so than ever in recent history, at least over the past 3 years here in 2025. You can't just have multiples that just keep going up and earnings do not follow there. So if tariffs go up, they weigh on earnings, they weigh on margins. They're absolutely going to weigh on margins, which will trickle down into earnings. We can't just say it's just going to go up because it's always gone up from that perspective there. Because again, if you buy at a top of something and you're down 30, 40%, it's not 30 or 40% upside to get you back to even. It's way more than that there. So things to be, we don't just blindly buy anything. So just be mindful of that. But again, if you're someone that says, hey, I have 15, 20 years until retirement, sure, it probably doesn't matter as much in terms of being specific around your timing. You're just in that accumulation phase. So I think it's going to matter depending on where you're at overall. Listening from Ireland, being away for a while myself. Nice. Show Mark your love and respect. I appreciate that. Mexico City is in the house as well. Is Costco a good buy? I think Costco, it's definitely looked at as a defensive stock, but in terms of valuation, it is very high there. Puerto Rico is in the house. Nice. I like that. All right. So let's keep rolling on our slide deck. So looking at our fear and greed index, I mean, it was just, what is it, guys? 2 to 3 weeks ago. Some of you could probably look back at our previous recording that we have. 2 to 3 weeks ago, we were sitting at an extreme fear with a score of 4. Here we are now up at a score of 27, which is the highest going all the way back to just a month ago. It seems like, we've been in this treacherous time period, but it's really only been a month ago since we were above a score of 25. We're sitting currently at 27 right now in terms of the fear and greed index. So let's take a peek over at our sector performance. So let's get this on the stage here. We'll remove that and we'll throw this on the screen. So here we go with our S&P 500. Let's zoom in so we can all see that pretty good there. So there we go. Taking a look at our year-to-date performance, still we only have 2 sectors that are in the green: consumer staples and utilities. If anything, those scream defensive right there. So up 6%, up 3%. Real estate trying to get back in the green, down less than 1%. Healthcare, financials, materials, all down roughly 2%. So again, it's broad. A lot of sectors are outperforming the S&P 500, which is good to see. And the leaders of the past few years are now the dogs of the past few years: consumer discretionary, info technology, and communication services. So think Google, Meta with communication services, infotech, think Nvidia, Microsoft, Apple, and then consumer discretionary, think Tesla and Amazon there. So again, shouldn't be much of a surprise, especially if you have concerns about a recession. Consumer discretionary is going to be the easiest one to say, hey, we're going to pull back on. Doesn't mean all of them will go down. I think Amazon can perform quite well in a recession. So, but typical cyclical consumer discretionary type companies, I think they can struggle a lot. I mean, you look at a company like Nike, it's kind of a double whammy. If we go into a recession and you think about consumers, do they necessarily need to go buy the new set of shoes or new clothing and stuff like that? And then you pile on to them saying, oh, a large portion of their sales is over in China. China is likely going to retaliate by having their consumers not spend on U.S. products. Well, hence Nike is a big seller in China. That's going to weigh there as well. So from a traditional valuation perspective, you could think that, hey, it looks great compared to its 5-year average. But like I just previously mentioned in my latest video, and if you haven't checked that out, definitely go check it out and give us a like there. I talked about a lot of this valuation stuff on not necessarily just comparing to the 5-year average. There's a number of different things. That's why I have my entire investing checklist for folks to go through to determine whether a stock is a good buy or not. Let's take a look at more recent. More recent, we only actually have one sector that's in the green. That is consumer staples there. Utilities is slightly in the red, only down by 0.2%. Real estate materials, again, not much change there. The big laggard, though, has been energy, which we've been getting some seesaw in terms of oil production there. So, or demand, I should say, especially if we're headed towards a recession overall. So, again, we talked a lot earlier about U.S. and China, the trade war there, and I think it's something that you have to take very seriously about looking at companies within your portfolio or stocks that you're looking at right now to maybe enter your portfolio to see how much exposure do these companies have to China. So I found this article here on companies that rely a lot, very heavily on China here. So you got MPWR, 53% of sales are coming from China. You have KLA, Lam Research, which just reported they actually had solid earnings today. Up, not up, but 37% exposure to China. I believe that is slowly coming down. Albemarle. So this one is lithium here. So think of EV batteries. A lot of that comes from China. NXP, Applied Materials, Corn. I mean, you could see a lot of technology stocks, technology-related, AI-related, chip-related stocks on this list. Intel, AMD. You have Tesla. APH, 22%. So you can see that a lot of these companies are down big on a year-to-date basis, and this was done back. This isn't actual year-to-date right now. This article is from last April 11th. So it's again a few weeks. So don't look at those and say, well, those aren't the year-to-date numbers. That was as of April 11th there overall. So let's jump back to our slides here. So that is a brief look at our sector performance. And let me take a break real quick to tell you about my 6-week investing accelerator. So we have reopened our enrollment. This is our group program. So I have a lot of people that have always been interested in working with me on the 6-week investing accelerator program. The majority of the folks that I work with, we do one-on-one. Well, those prices are quite high, and a lot of people get priced out, and they want to do it, but it might just be too pricey. Well, this is why I started the group program. Some people learn great during group sessions here. You're going to learn a lot of the same material. Obviously, we won't be able to get as customized as some of the individual folks, but we're going to go through how to invest in a recession, how to analyze and build a strategy for yourself, how to not only analyze the health of a company, but also the most important thing there is, how do I know when to buy and sell? And that's where we're going to go through my checklist and to see how to value stock. So this will be starting. This is a group program. You'll be able to access there, ask questions live, just like we're kind of doing right here, except it won't be open to the public there. But these sessions will start on Tuesday. Each session is roughly 60 minutes in length. It's all taught by me. I don't pass you on to any other teachers or anything like that. And if you're unable to join us live, that's okay. You will get a link to the recording as well and have access to myself to ask any questions that you have on any prior sessions there. So hope to see you guys join us. Right now, we've opened up another 5 spots for a $750 discount. Those are, again, just going to come on a first come, first serve. The first 5 already went from my emergency market update that we had last week. And now I'm going to open up another 5. Once these are gone, we will be done with the discounts there. Prices will go up. So first come, first serve as it pertains to signing up for our 6-week program. And if you have any questions on that, feel free to pose those in the comments section. I'm going to drop the link for any of you that want to join or find some details. That is in the comment section right there. I will drop it after this program into the description as well, so that you guys can check that out as well. So thank you for becoming Unkin, a new member right there. Thank you very much. And if you guys ever have questions and you guys are members, pose those in there, and I'll definitely make sure that I get to those, because you do get priority there. So hope to see you guys join us for the 6-week program. Again, that will be starting next Tuesday at 8 p.m. Eastern time, 5 p.m. Pacific there. So you can join us live. Usually it's about a 50-50 crowd, where we have 50% of all the folks that signed up for the program will join live, and the other 50% are able to take it at their own pace, whether they're traveling different time zones, whatever the case may be based on your schedule. You will still get the data even if you're unable to join us live. You'll get access to all of our slide decks and everything there. So appreciate it, and look forward to seeing all of you guys that are already signed up, and those of you that are about to sign up there. So let's go take a look at our Fed Watch tool and see, what are we thinking in terms of the next Fed meeting there. So Jordan, appreciate that. Hit that like button right there. All righty, so let's jump back over to our screen right here. Here we go. So right now we are overwhelmingly in the majority here. 96% believe that rates are going to stay unchanged, with the next Fed meeting coming on May 7th. So we are still about a couple of weeks away from the next Fed meeting. But you can see how that's kind of changed over just a week ago, or even a month ago, where it was 85. It was still overwhelmingly believed that we weren't going to have any. Again, this is what I talked about at the open. And if you weren't here at the open of this stock market after hours, I discussed the fact that there is no reason. The Fed has told us they are going to be data dependent. They're always going to be looking at data that's looking back, which, whether that's the right way to approach it is another argument for a different day, but they haven't swayed from that. And right now, when you look at things like jobs, and when you look at GDP, whether you believe of where GDP is going, but based on it right now, there is nothing that's leading them to believe that, hey, we should probably cut rates right now. They've talked about the impact that tariffs are going to have. They've talked about lower earnings estimates and the impact that it could have on rising unemployment. So they're looking for those numbers, but they're going to wait until they see them before they choose to act by any means there. So that's where we're at in terms of the Fed Watch tool overall. So some of the things on jobs that I want to take a peek at here was our latest weekly jobless claims. So we saw those. And again, I don't pay much attention to the weekly jobless claims, because those could be seesawed. There could be one-off events. I rather look at what's called the continuing claims. So these are folks that have been collecting unemployment for at least the past 2 weeks and stayed on the unemployment benefits. So continuing claims increased 41,000 to about 1.9 million people that are currently unemployed. And when we look at these figures, you can kind of see the chart here over the past 3 years. I mean, if you just go back to 2022, we were at 1.4 million. So today we're hovering around the highs, and the highs were 1.89. Right now we're at 1.89. So again, I'll zoom in right there so that you can see in March, we were at 1.89. In the end of February, we were at 1.89. And that has been the highest in the past 3 years there. So something to keep an eye on is these jobless claims. You have a lot of this Doge stuff going on that's cutting jobs. In fact, you have a lot of companies that are requiring employees to come back to the office. We had a lot of these pandemic policies from companies that said, hey, you can work from home. A lot of people transitioned to full-time work from home. But now we've already heard about it in the past 12 months. Some companies saying, hey, you need to come back at least 2 to 3 days. But I'm starting to hear a lot more. Google just announced it, that you have to come back to work for at least 3 to 4 days for many of the positions. And if you don't, you lose your job. There's no ands, if, or buts around it. There's many private industries of friends and family members that I have that said, hey, you have to come back at least 4 days a week or else risk losing your job. So I'm looking at this saying, this is an easy way for companies to say, we don't have to lay it. No company likes to lay people off. There's no employer out there that just enjoys laying people off. So if you enact a policy like this, you could maybe get a few people to lose their or choose to move on and go try and find a more flexible work arrangement. Hence, they don't have to lay people off. But if that doesn't work, then we're going to start seeing some uptick in potential layoffs there. So I believe that's, if you pay attention to it, you're going to start seeing a lot more of these businesses moving that direction first before moving to layoffs there. So something to keep an eye on. Some more economic news that we got recently, which I found kind of interesting, was new home sales. They jumped in the month of March. Again, this is a look back here. So supply is still pretty tight overall, but when you look at new home sales, they jumped 7.4% during the month of March, which is interesting because we're in the face of slowing economy. We're in the face of potential layoffs. We're in the face of high interest rates, and people are going out and still buying new homes. So it could just be a comparable to the prior data that we saw, but it was a nice little bump and definitely some positive news that consumers are still spending to a degree. So we're not falling off a cliff, which is a good thing for the economy overall. Some other things that I was, in preparing for this was looking back over the past 5 days, over the past month, we've started to see semiconductors to a degree, although it's been volatile, actually outperform the greater technology sector. So this is a comparison to semiconductors versus QQQ. And as you can see here over the past month, QQQ has actually outperformed there, but we've started to see semiconductors to a degree. I think it's a case-by-case basis start to waken up a little bit here. And we've closed the gap in the past 5 days is what I just mentioned here, where we could see where SMH is actually only down 2% compared to QQQ being down 1%. So starting to close that gap in what was, a 6%, 600 basis points difference, we're starting to see a little bit of that gap close. So something to watch overall. Let's go over to the charts real quick before we get to anything else here. So let's take a look first at the S&P 500. So if we look at the S&P 500, if you focus on this trend line here, this red trend line a very sharp down trend line that we got going, this will make things a little bit better there. We can see that the lows back in March of this year was hovering right around 5,500. And if we take our trend line down, we saw the S&P 500 fall to a low of 4,860, we'll call it. It has since rebounded and touched today 5,460, 5,450 in that range right there, which is right around our 5,500 number, slightly below, that I'm drawing out right here between the cross section of the lows of March, which is going to be the green line, and then our downtrend line. And on top of that, you want to mix into is you want to follow retracement lines. So the drawdown from the highs of February at 6,150, we fell all the way down to 4,840. If you take half of that 50% retracement, is exactly that 5,500 level that I'm talking about right here. So it would not surprise me in any day, week, that in the near future here, that we see the market fall back here, because usually after big drawdowns, we'll see a 50% retracement. It'll get back to recovering 50% of those big losses on a big drawdown like we've seen here in the S&P 500, and then come back and take another breather here, which is why a lot of my options are set up to the downside right now with debit put spreads on SPY and things like that. And you can join Options Edge Plus if you want to see some of those trades there. Doing credit call spreads on things like Netflix, which has just been fantastic. I mean, if there's a stock, you're like, what stock's working? I mean, look at this one from a technical perspective, bounce right off. I mean, I'm talking about right off its 200-day moving average and shoot up from 825 up to now over $1,000. But where are we hovering at right now? If we take that green box, the highs for that particular stock, 1065, call it. And the stock has beaten up against that 2 days straight now. We had a big move in the S&P today. It was up, well over 3% at one point. When you looked at Netflix, it was up around 1%. So it wasn't really partaking when you saw, the likes of Amazon at one point that was up 7%. You saw the likes of Tesla that was up 8% at one point. Netflix, a lot of that buying appears to be weaning a little bit right now, hence why I went and did a credit call spread looking for a little bit of near term. Now, that's a stock I think can work during a recession, but right now it just appears like it's a little bit tired to the upside. You got RSI sitting in the high 60s right now, so thought that was a good opportunity to take advantage and try and make some income there. So those of you that are on Options Edge Plus, you saw that trade alert that was out there as well. So another stock that I'm kind of paying close attention to right now in terms of buying or doing more of a cash secured put is going to be CRM. So Salesforce. And Salesforce, you could see, has some pretty solid support around that 230. So if I would be looking for a strike price right now in terms of some options, probably a pretty good spot, because if we date back all the way to June of 24, buyers crept in at 230. If we fast forward up to August, buyers crept in again right at that 230 range. Now we are retesting that all over again. All of those gains have been completely lost. And if we go back to April 7th, so just a few weeks ago, where did buyers creep back in? Right at 230. We touched 232 here in the past 2 to 3 days ago. So again, that's how I build out what strike price I want. I would go look at valuation. Does that make sense? Is that a stock I'd want to buy at that particular price? And that's how we build out those models and those strike prices there. You could get a little bit more conservative if you wanted to and go down to the 220 lane, 220 target. Going to get less premium there, or you can make it into a spread if you wanted to as well. But those are levels that I'm looking at for a stock like CRM. We looked at Netflix there. And we looked at the SPY overall. So that is what we are continuing to look at for a few stocks I wanted to make note of there. Tariffs we talked about continue to rule the market. And we did talk about some things that are in the news right now. So let me jump over to our newsletter, where you get our weekly midweek wrap up, which again, you can join. There's a link down in the description down there below. So this is our midweek wrap up that just came out. Give you some news on what's going on. Again, it's free to join this right here, but if you do want some of the more in-depth details, you would have to be an Edge Plus member, so you would see everything that's kind of written in this box, which is going to be a great deal of stuff down below. So let's take a peek here at Tesla real fast. So Tesla reported earnings yesterday. It was a massive miss. I mean, this was just a terrible report overall. But what does Tesla do best? Let's kind of take our investors' eyes and have them focus elsewhere. Let's have them focus on the robots or the cabs, or let's start a lunar EV company or something like that. So again, and when you look at the details, though, I mean, they missed massively here. And the automotive, they're starting to, they used to want to try and separate themselves. We're not GM, we're not Ford. Well, Elon, the numbers are starting to make it look like that from a margin perspective, from a lack of operating income on automotive. So the bet, though, when it comes to Tesla and shareholders, is not really on automotive. It's going to be elsewhere from AI capabilities, from robotics and things like that. So again, Tesla continues to be one to play with options for some huge premiums, but the risk level is quite high overall there. So some key points that we have here in our newsletter that you can see. So we had the EPS miss, we had a revenue miss. There's our automotive revenue, which was down 20%. Net income was down 71%. But the big thing that I took away here was look at this energy revenue. So think of the solar panels that they have and battery packs. This further tells me that NEE, which is a stock that I recently added to, continues to be a solid name, and you can get it right now at a great valuation. So if you don't own any Next Era and you're looking for a solid dividend type play, I mean, look at this right now, trading right around a 52-week low. You're getting a PE of pretty much below 18, but check the dividends. Not only are you getting near a 3.5% yield, you're also getting dividend growth, and a company that's been growing their dividend for nearly 30 years. Yield, great valuation, and dividend growth checks off a lot of the boxes right there. So definitely pay attention to Next Era Energy right there. And again, if you are just joining us, this is our Investing Accelerator checkout page. So again, I hope you can join us for our 6-week program. It launches next Tuesday, 8 p.m. Eastern. You do not have to join us live. You will get the recording and you could take it at your own pace. But if you are able to join us live, that's going to be the best way, because you can ask questions right there on the screen, and I'll drop the checkout link down below. I already did see on my screen over here that someone did sign up for the $750 discount there. So there's 4 spots left. I know I told you guys earlier there was 5 spots that we did open there. So there's 4 spots left at that $750 discount. You can use that link right there to get signed up. That will get you access, and you will save you your spot. You're going to get access to my valuation checklist, any of my compounding calculator worksheets, any of the slide decks that we go through, and a slew of other things to help you not only prepare, give you the blueprint, something that's going to work today, tomorrow, and for years to come. And there's plenty of people that are in this stock market after hours right now that have taken the one-on-one program that can vouch for how it has changed their look on investing and given them that blueprint, given them direction, and how they can now create a thesis on why they want to buy a stock, why they want to sell a stock, what is overvalued, what is undervalued, what is a healthy company, what is a company that's over leveraged, so on and so forth. All of that is built out on our valuation checklist. We'll be teaching all of that to you within our 6-week program. So hope to have you guys join us there for that. Again, we have 4 spots open. So any other questions? That's what we got for the stock market after hours for you here today. Again, it's been a pleasure being with you as always. And again, I hope to see you guys within our 6-week program. So again, if you haven't done so, please hit that like button down below. I truly appreciate it. Definitely helps with the algorithm. And subscribe to the channel if you're not yet subscribed there. So thank you guys so much. And we'll catch you next week, or we'll catch you Tuesday for our 6-week Investing Accelerator program. All right, folks, take care. Bye-bye.